Mimicking the ultra-wealthy is the fastest way to stay poor. Most people study the success stories of the 1% to find a roadmap for wealth, but this creates a massive statistical blind spot known as survivorship bias. By only looking at the winners who survived a high-risk environment, the millions of people who used the exact same strategies and lost everything remain invisible. This video breaks down why the most popular money hacks are often statistical anomalies and how understanding the missing data is the key to building sustainable, long-term wealth without gambling on a miracle. The data reveals that the path to true financial independence looks nothing like the highlight reels on social media. Survivorship bias is a logical error where one focuses on the people or things that made it past a selection process and overlooks those that did not, typically because of their lack of visibility. In finance, this creates a hidden graveyard of failed businesses and bankrupt portfolios that no one talks about. Consider the performance of mutual funds. When a fund family advertises high returns, they often omit the dozens of underperforming funds they liquidated or merged out of existence that same year. Research from S&P Dow Jones Indices shows that over a 15-year period, nearly 90% of actively managed large-cap funds failed to beat the S&P 500 index. When investors only see the surviving funds that outperformed the market, they assume the management strategy is foolproof, ignoring the fact that it might simply be the result of a lucky streak in a large enough sample size. This is known as the hot hand fallacy, applied to capital markets, where past performance is mistaken for a repeatable skill. The same logic applies to the side hustle culture, where the success of a few viral creators overshadows the 95% of small businesses that the Small Business Administration reports fail within the first decade. Most entrepreneurs are looking at the 1% who reached the finish line without studying the 99% who hit the same obstacles and didn't make it through. The data tells a different story. Success isn't just about following a winner's routine, but about avoiding the common points of failure that the winners were lucky enough to miss. A common narrative in personal finance suggests that skipping traditional education to start a business is the hallmark of the ultra-successful, citing figures like Bill Gates or Mark Zuckerberg. However, this advice ignores the safety net factor that many of these outliers possessed before taking their leap. Data from the Bureau of Labor Statistics consistently shows that workers with a bachelor's degree earn approximately 67% more per week than those with only a high school diploma. For the average person, dropping out is statistically correlated with lower lifetime earnings and higher unemployment rates. The outliers often come from backgrounds with significant, invisible capital, such as family connections, elite social networks, or trust funds that provide a cushion against total financial ruin. Without this capital, a single failed venture can lead to decades of debt, whereas for the 1%, it is merely a learning experience funded by private equity. When a person with a net worth of $50 million tells others to risk it all, they are speaking from a position where all does not include their basic survival needs or housing security. For the average household, risking everything means something entirely different and far more permanent. But here's where it gets interesting. The bias doesn't just affect career choices, it actively distorts how people manage their existing savings and investment portfolios. Retail investors often attempt to mirror the whale trades of hedge fund billionaires or high-profile venture capitalists, assuming that what works for a billion-dollar fund will work for a $50,000 retirement account. This ignores the fundamental difference in risk tolerance and capital structure between a retail investor and a whale. Institutional investors often use sophisticated hedging strategies, such as derivative contracts and short positions, to protect their downside, tools that are often inaccessible or prohibitively expensive for the average individual. A billionaire can lose 90% on a speculative tech bet because it represents only 1% of their total net worth. If a typical earner puts 50% of their savings into a single high-growth asset and it drops by 50%, it could take years of labor to recover that lost principal, whereas the ultra-wealthy survivor simply moves on to the next deal. The math of expected value shows that concentrated bets are only rational if the gambler has the bankroll to survive a long losing streak. Furthermore, insider sentiment is often priced into the market by the time it reaches public headlines, meaning retail followers are often the exit liquidity for the survivors they are trying to emulate. Following the herd into a proven winner often happens just as the growth cycle is reaching its peak. The data tells a different story. The most reliable way to build wealth isn't through mimicry of outliers, but through the mastery of boring, mathematical averages. Successful long-term wealth building is grounded in the law of large numbers rather than the search for a unicorn investment. Historical data shows that a diversified portfolio of low-cost index funds has outperformed the vast majority of active traders over any 20-year window in the last century. The power of compounding relies on the avoidance of catastrophic loss, which is the primary risk of copying the concentrated portfolios of the 1%. If an account loses 50% of its value, it requires a 100% gain just to break even, a mathematical reality that kills many high-risk hacks. Studies by companies like Vanguard have shown that asset allocation and the minimization of investment fees are far more predictive of long-term wealth than picking winners. Reducing annual fees by just 1% can result in hundreds of thousands of dollars in additional wealth over a 30-year career due to the effects of compound interest. Instead of looking at what the 1% are doing today, most households benefit from looking at what the 99% who became the millionaire next door did. They lived below their means, invested consistently in broad markets, and ignored the noise of the outliers. According to the Federal Reserve, the median net worth for those in the 75th percentile of wealth comes largely from home equity and retirement accounts, not speculative ventures. True financial education isn't about finding the secret of the winners, but about understanding the probabilities that govern everyone else. The most important takeaway is that wealth is built by surviving the market's downs, not by gambling on the one in a million ups that the media loves to highlight. If this changed how you think about wealth building, the next video breaks down the psychology of why most people fail to stick to their financial plans during a market correction.